Well, good morning, good afternoon, or good evening, depending on where you're sitting in the world as you join us for today's Moomoo presentation. When I say join us in the Moomoo community. For today's presentation, are the best gains of 2025 still ahead of us? Something for us to consider. It's an important aspect of markets at the moment, particularly given recent events, both at the macro and the micro level. There's a lot for investors to consider with the current market outlook. And the key question is based around our second half outlook. Now, you may have seen that we released just before the end of the first half of the year there in late June, an outlook paper where we canvassed the macro conditions and the micro conditions that could drive markets over the year. And today's webinar will start with a look at some of those calls that we made back in June and see how they're panning out. But before we get going, there's some important information for everyone to consider. Today's presentation is made by Moomoo Securities Australia. And as you can see, we have an AFSL licence. We're regulated by ASIC, the Australian regulator. And you can see our licence number on the screen there. Perhaps even more importantly, today's presentation has not been prepared with your personal circumstances in mind. And so the key aspect of this is that if any of the information is useful to you in considering your investment outlook or your investment actions or your trading outlook, that's a decision entirely for you. And if having read the information in our product disclosure statement and our FSG, you're still not sure about the risks, please seek independent advice. And with that important information at mind, today, we're going to look at how those global trends we highlighted in the middle of the year are unfolding. Some of them appear to be unfolding as we expected. Others have been different to what we're looking for, and we'll discuss why that might be. We'll then look at the investment and trading strategic issues that arise from the current market conditions and some of the aspects that investors and traders may wish to keep in mind as they make decisions about their financial future. We'll drill hard then into one of the key learnings from the earnings season. Now, we've just completed earnings season here in Australia, in the US and in Hong Kong. We've learned a lot about the on-the-ground experience of corporates, and we've seen very significant reactions in the market. We'll look into why that might be and how investors can use the information that was put in front of us during those earnings seasons. And then we'll turn to the market outlook, and I'd like to highlight a number of markets that I think could be very important for investors to keep an eye on as we move into the last half of 2025. So let's start by looking at how those global trends we identified in the middle of the year are unfolding. Now, one of the key learnings from the tariff ructions of April was the impact that bond market disruption can have on politics. Because while share markets' initial reaction was shrugged off by the White House and it continued to introduce tariffs, once bond markets became involved and a bond market sell-off got well underway, that seemed to be the note that brought caution to the US political scene. And so it is still one of the markets we're watching very closely. Now, the good news on that is that we've seen bond yields calm down. They've returned to more normal trading conditions. Both the shape of the curve and the outright level of those rates looks more normal following that disruption in April. By that, I mean that the 10-year yield has fallen from those danger levels above 4.5% back towards 4.2%. And while it's at that level, we're not seeing signals of alarm. But bond markets remain one of the most important markets, and particularly given the indebtedness of many governments around the world, I'm thinking particularly of the US and Japan, bond rates will continue to have an important impact on investment decisions around the globe. So one we're continuing to watch, a trend that at the moment has calmed down, but remains a canary in the coal mine. It remains a harbinger of anything that's suggesting market structure is fracturing. So it's one we're watching closely, but at this stage has not panned out necessarily the way we were concerned. One thing that is working out very much in the way that we thought might happen has been the pressure on central banks. And while there's been political pressure on central banks, the reality is it's their dual mandates that's really causing the problems for central bankers and leaving them stuck between a rock and a hard place. And we'll drill into that because the implications on central banks and the conflicting pressures that they're seeing to act mean that this could continue to be a theme, not just through the second half of this year, but well into 2026 as well. Another theme that we looked at as part of our mid-year outlook was Bitcoin and cryptocurrencies generally, and in particular the calls at those time that Bitcoin might get to $180,000. Well, we're not moving away from that call. That is still a possibility, but that has not been the way things have panned out, particularly over the last 3 weeks. We've seen real pressure on Bitcoin. While it did go to a new high after we published our paper, it was trading around the 108,000 mark when we published, and we did see it reach a high just below 125,000. Since that point, Bitcoin has come under pressure and it's back down under the 110,000 US dollar mark. And that slide is starting to look like a developing downtrend. So Bitcoin perhaps a bit disappointing for some. Of course, it is dominant in the cryptocurrency sector, and that pressure on Bitcoin is translating to pressure across the crypto complex. So we're looking to see how it goes if it reaches important support points. 100,000 US dollars to 98,000 US dollars is a very important support band. And if we were to see a breach of that, the next major support levels are at 88,000 US dollars, then 76,000 US dollars. So we're watching this $100,000 level very closely at the moment. Of course, it could act as support and see a turnaround and a new uptrend emerge that might see a test of the all-time highs. And of course, given the volatility in Bitcoin and cryptocurrencies generally, we can't rule out anything in the near future. One to look out for, but certainly going against what we see as the major uptrend in Bitcoin at the moment. Semiconductors remain as popular as ever, although some of the share price appreciation has slowed down after that big bounce in May and June. The reality is they're still market-leading companies, and NVIDIA is still the world's most valuable company by market capitalization, and semiconductors remain a crucial theme strategically and economically, and that support for the sector does not look like wearing out. Now, we do note that when market jitters emerge, the semiconductors are often the worst performers. Having been the best performers on the way up, they're subject to the most pressure when selling hits the market. So it's important to remember that risk and reward in markets are always tied together, and those higher rewards and the bigger gains we're seeing in semiconductors come at the risk of a downdraft and underperformance during any market downdrafts. But nonetheless, that semiconductor trend remains ongoing. And at this stage, given the emphasis on artificial intelligence and other technology-enabled productivity gains, it does seem that that is inclined to keep going throughout the rest of the year. We're seeing a rapid gain in value. The most recent earnings season in the US in particular was very pleasing in terms of what semiconductor companies reveal, with many of them showing increased profits above and beyond the very lofty expectations that have driven their share prices. So certainly some justification in the reports we've just seen for that ongoing strength in semiconductor-related stocks. The bull run for gold, well, a good time to be talking about that, given that gold in the last 3 trading days has reached back towards its all-time high in US dollar terms, tapping out just below the 3,500 US dollar mark in trading over the last 2 sessions. It does look like, given the uptrend we're seeing in the short term, we could see a test of that level and a potential breakthrough to new all-time highs for gold. It's clear we have upward momentum at the moment, and while that can reverse any time, and of course some of it does relate to recent US dollar weakness, nonetheless, the outlook for gold, at least on the charts, remains positive with real upward momentum. We're certainly seeing that repeated. Many of the gold stocks seem to be used once again as trading counters. So despite the fact that gold traded higher last night, we're actually seeing a bit of underperformance from gold stocks in the market today, but that might reflect the fact that they rose so strongly yesterday. Northern Star up 6% yesterday, Capricornia up 12%, and others doing very well in trading yesterday. And it does appear that local traders successfully anticipated last night's rise in the gold price. But nonetheless, despite those short-term fluctuations, the gold uptrend still seems to be in place, and many investors happy to be in that space. One of the other themes that we touched on in our outlook was the possibility of US dollar de-dollarization. US de-dollarization. This idea is that the world will move away from the US dollar as a reserve currency. And one of the reasons for that is the shifting in the economic centre of the world. While the US remains the world's largest economy, these days it's only just. The expansion in the Chinese economy is rapidly approaching the size of the US. And of course, we've also got India expanding at a rapid rate of knots, tipped to soon become the third largest economy in the world, overhauling Germany. So we've got a lot of change going on in the economic world, and that could mean a shift in the centre of finance that supports the trade-related activities of the globe. It's an interesting piece. I don't think it's coming close anytime soon. The reality is the liquidity and the free-floating nature, as well as a deep and liquid bond market, are all requirements for a reserve currency. The US dollar can meet all of those currency requirements right now. It would be hard to identify others that could necessarily do the same. And it's certainly not in the crypto world, where the friction of processing transactions means that at this stage we can't see crypto taking over from the dollar. So at this stage, still an interesting idea, might be part of a long-term trend, but there has been further pressure on the US dollar. I think this more relates to trade flows and investment flows rather than any de-dollarization movements, but nonetheless interesting to see that falling US dollar. We'll learn more about the causes of that as we go along. So these global trends are the key ones we identified at the middle of the year. Looking at the strategic issues that arise from these trends, there's a couple of very important factors. And I know that a lot of moo-mooers are onto this idea, the idea of the momentum that we're seeing in the share markets, and particularly in those US shares, versus the valuation concerns that are being regularly raised. And these are very real issues. The interplay of these two issues is a factor that it will be very important over the next 4 months into the end of the year. And this is one of the reasons why. This is the NASDAQ 100. This is, of course, contains the Magnificent Seven and a lot of other tech stocks. It's one of the best performing indices over the last few years. And given the growth that we've seen in earnings for a lot of those tech companies, some of those gains at least are justified. Well, what we have here is a fairly ugly looking trend. And as you can see, in the bounce back from the April sell-off, there was a very steep gains, particularly early on in that trend. But over time, we've seen it bend back towards that trend line I've drawn on there in blue. And you can see that we've now come back to that trend line and are crawling up it. Now, I know plenty of you will argue with me about where I've drawn that line, but the point remains that this uptrend, one, remains in place, but two, is decelerating. And that's why it's an important time to be on alert as an investor, because this is the global leading index. And where the NASDAQ 100 goes, the rest of the world, in rough terms, is very likely to follow, because it's a harbinger of sentiment. So while we've got an uptrend in place in the NASDAQ 100, overall, the outlook remains positive for global shares. Should that uptrend break, then we could have some big concerns. And just to make sure I've got the level right, you can see over to the left there, there's a couple of peaks just above the 22,000 mark for the NASDAQ 100. And if we were to see the NASDAQ, first of all, break the trend line and then drop through that 22,000 mark, that could be a sign of further falls to come. It's certainly something as a trader and investor I'm looking out for, and I would take that as a very serious sign if we were to see that. However, what we do know from statistical analysis of price action is that trends in markets persist for a lot longer than we would expect if markets were just a random walk, as they're sometimes called. So those trends are an important feature of markets. They've been mathematically demonstrated to persist beyond the random nature that some people believe markets follow. And because of that, many traders and investors lean on trends. And that's what I'm doing at the moment in the market. While the trend is in place, while it's not broken, I'm happy to run with it. But if I see signs that it's breaking, I'll be looking out for it. And as I pointed out, a break of the trend line and a break of 22,000 in the NASDAQ 100 would be of a major concern for somebody like myself. I'm going to also highlight towards the end of this presentation some other markets I'm watching closely for signs that the good times that we've been enjoying mainly for the last 3 years might be coming to an end. And it's a risk alert. So while we've got that positive momentum, that is good news. And as we say, statistically is likely to continue until it doesn't. And so we have to be on alert for the market signals that the market conditions are changing. This is not going to be brought to us by valuations because, as I can show you on this next screen, valuations remain very stretched. Now, this graph is worth spending a bit of time on because the blue line, the single line, is the NASDAQ 100 index. And this is since 2015. So we're looking at 10 years worth of trading. Now, the green candles on this chart is the PE ratio of the whole 100 companies, the price of the 100 companies versus the earnings of the 100 companies. Now, as you can see, right in the middle of the chart, there's a huge spike. And that spike is in 2020 and 2021. Now, that was not a case of tech earnings exploding. Instead, it related to the cratering of the price, of the big fall in the NASDAQ index at that beginning of 2020 and the time that it took to recover. Now, you can see that that price earnings ratio took off during that pullback, and it took quite a long time for the adjustment by analysts to their earnings estimates to bring that PE ratio down. So that spike in the middle of the chart was actually a function of a falling price rather than rising earnings. Whereas on the right of the chart, where we are now, we have rising market and rising earnings, but you can see that the market is running well ahead of where the earnings are in terms of the ratio, and that the market is once again, excluding that COVID period, approaching its all-time highs for price to earnings ratios. So that tells us valuation remains very stretched. And this is the interplay, the strategic import of this. Valuations are stretched. There's no two ways about it. But valuations are no longer a dependable measure of when the market might turn. Instead, to find out when the market might turn, I'm going to look to the price action to tell me when the crowd decides it's had enough. So momentum versus valuation, a key strategic import for the market. And another key strategic issue for markets and trading is the jobs versus inflation conundrum. Now, I spoke before about the difficulties that central banks are facing, and it's because of these two factors. Jobs and valuations are at the heart of every central bank mandate. The Federal Reserve has a mandate to maintain employment conditions at as full a level as possible while maintaining stability in prices. And those words and that idea are repeated throughout the mandates of central banks throughout the globe. In other words, it's about inflation and it's about employment and unemployment. The issue for central banks at the moment is that it looks like employment conditions are softening. We're seeing that in all sorts of measures. And of course, as many of you would know, there are many measures that we use for inflation and unemployment. And on this screen here, you can see on the left, Australian unemployment rate. The blue is the actual, the orange is the projected or the consensus forecast. And as you can see, although it took a little longer than expected, unemployment is on the rise in Australia. And on the right-hand side here, you can see the initial jobless claims. Now, the beauty of this number is that it's published weekly. And you can see quite clearly that the recent trend in jobless applications, claims, has been increasing. And that's a concern because unemployment rising is generally a sign of a softening economy. Now, generally, we would hope that the Reserve Bank or the US Federal Reserve would leap into action and start lowering rates, lowering monetary policy to make an adjustment for that rising unemployment. But the problem here is inflation, because the other side of the mandate is managing prices and inflation. And as you can see on these charts, on the left Australia, on the right the US, inflation is also rising. And the normal response from central banks when inflation is rising is to jump on the brakes. That is to lift interest rates, slow down the rate of money in the economy and make the price tighter to slow down the economy and take the heat out of inflation. So now we have a real conundrum for central banks. They've got rising unemployment, which should mean lower rates, and rising inflation, which means higher rates. And how they respond to that is going to be a very important factor for markets, particularly given the very heightened expectations that we'll continue to see rate cuts to support economies. Now, I would suggest that those rate cuts we saw were a central bank reaction to emergencies in COVID. and that we shouldn't expect that every time the economy softens somewhat, central banks will leap into action. Central banks don't see themselves that way, and many acknowledge that interest rates are a very blunt instrument when it comes to managing economies. So they prefer to see fiscal responses, that is, responses in policy from governments, rather than having to move interest rates every time we get a good or a bad read on inflation or growth. At the same time, they don't want to let inflation spiral out of control. So I think we're moving away from the era of central bank support for markets. I think they're going to move much more into a balance between jobs and prices. And given the conflicting direction of both of those, it's more likely, in my view, that interest rates around the globe will stay on hold than be cut or raised over the rest of this year. And if that becomes market convention, it could see a repricing. Because as I say, at the moment, markets are expecting more rate cuts this year. In fact, at the moment, market pricing is indicating an 88% chance of a rate cut in the US in September. So if that's not the case, market reactions could be very important. And it's why all investors should be paying attention to unemployment and inflation data right now. Moving on to the earnings seasons that have just concluded, we've seen some very impressive performances from US companies, and overall the outlook in the US was justified by the gains that we saw over the quarter. A 6% gain across all 500 of the S&P 500 companies. 6% gain in revenues led to around a 12% gain in profitability. And that's a very impressive quarter in anyone's book. And given the lofty heights of US markets was needed to justify, but to a large extent, we've seen some justification for those higher share price levels. We saw strong results too in Australia, but it was patchier, and there were certainly some real disappointments, and we'll have a look at some of those in a moment. Hong Kong was in parts lacklustre, although there were exceptions, and one we saw yesterday was Alibaba, a 20% gain there after it reported its results late last week, and dragging the Hang Seng index higher with it in trading yesterday. There is still concerns for the overall outlook for growth in mainland China, and that might be one of the reasons why we still see good value in the Hang Seng market relative to other major global markets. But from that, we need to sort of summarise, I think, the outlook, market outlook. I'll go to some charts that illustrate how that earnings season played out, but the overall outlook here is that current conditions have positive momentum. There's no doubt at the moment that around the globe, the trend in shares is upward. And as I've touched on already today, upward trends in markets, in share markets, persist longer than we would statistically expect. And one of the most powerful dynamics that traders lean on when looking at markets. But we do have real concerns, not least valuation. At the moment, we're looking very stretched in many, many sectors, and valuations, I would argue, and looking at that NASDAQ 100 chart, are at all-time highs or very close to, just like the markets themselves. And that does mean that any panic, any issues that raise real concerns could see very sharp reactions in the market. So as touched on, once again, rewards and risk are related, and the rewards here with the upward momentum are on offer. However, they come at the risk of potentially sharp corrections. And it's not just valuation concerns that bring about those risks. Trade concerns are very real. As we saw in April, market potential reactions to tariffs could mean that we could see them rear their ugly head, and trade concerns could come back to haunt markets given the stretched valuations. We note with concern that the courts have become involved in the US with some of the issues around tariffs. And in fact, the appeals court struck down some of the tariffs that were introduced in April, but gave a delayed striking down until October, so there's room for appeal. But it does potentially mean that there will be significant shifts in US trade policy as the White House and the Congress deal with court rulings on these issues. And that's just another risk for the market. There are also, of course, concerns around the outlook for the European economy, and particularly given their constrained energy situation. There are concerns about the growth outlook in China, although the recent resolution of property issues is definitely a positive for the outlook there. And there are, of course, the potential for left field or black swan events in markets. So for all of these reasons, it's important investors and traders stay aware of the risks in markets. But one of the dynamics that is driving the market is that bad news is good news. That when we see weak economic data, we often see the market rally. And this can be confounding, but it relates back to that dynamic we discussed a little earlier about central banks. The expectation is when we see bad economic news, if the economy in the US or elsewhere is slowing, that the Federal Reserve or the central bank will jump into action and lower rates, thus spurring markets higher. So we do have a bad news is good news dynamic. We also seem to be having a good news is good news dynamic. In other words, the momentum is overruling almost everything we're seeing. And although when we do get concerning reads like we did on Friday night with the inflation read in the US, ticking higher to 2.9% at the core level, away from the Fed target, market reactions can be swift. We saw the Nasdaq down 1.2% on Friday night. So it's something to be aware of. If we start to see a shift where bad news is bad news, investors need to be very aware of that. And I'll give you, as I say, some ways to look at that. But one thing to consider as investors and traders is those opportunities to take asymmetric risk. That is to look at ways to enjoy benefits from gains without being as exposed to downside issues. And there are a number of instruments that investors and traders can use to do that. But the warning signs I'll be looking for relate to markets, because I do think this is about market sentiment and about investor beliefs about the market. And while the markets continue higher, they will continue. So I'm watching for signs that the market has lost momentum, that investors are starting to change their minds about the outlook from positive to negative. And here are the key instruments I'll be watching. The Dow Jones itself is an instrument I'll be watching, and I'll go to the chart and explain why in a moment. I'll be watching those 10-year bonds, particularly if we see them move back up to those danger levels above 4.5%. Any move above 4.5% for the 10-year bond in the US would, for me, be a red light flashing for US share markets. Also looking at the US dollar, but particularly versus the Japanese yen. But this is not a de-dollarization argument. It's about investment flows. Japanese investors and European investors are the most significant in the world when it comes to the flows of individual investment internationally. And so dollar yen and the euro US dollar cross can give us real clues as to what's happening. And if we start to see outflows out of the US, that is a weakening US dollar against the yen and the euro, that could be a sign that international investors are moving away and could be a signal for all investors to examine their portfolios. So a couple of things to look out for. Just quickly on those charts, you can see why I'm looking at the Dow. On this chart, you can see that there's a mark there at the 45,000 level. And now we're not far away from that. We're just 2% above that level. So it is a good near-term indicator. If we see a dip below that level, it doesn't necessarily mean a downtrend is starting, but it would be a warning sign to be on alert. And if we saw it confirmed by a move below that 22,000 level in the Nasdaq 100, for mine, that would be the signal to change direction for the market. One to watch out for. I've mentioned the bonds before. We don't need to take a close look, but you can see here that trading range over the course of this year has been important. That reach up towards 4.6% was what I believe turned the tide politically when it came to tariffs. So now that we've come back towards the 4.2% level, that danger has receded somewhat, but always one that I check every morning to make sure it's not approaching those higher levels. And a break upward through that 4.6% level would, for me, suggest a test of those highs from last year, around 4.75, and a breach there would be a very bad sign for market sentiment, at least in my view. Turning now to the US dollar versus the Japanese yen over the last 5 years. So these are longer term charts, bear in mind. We've taken out a lot of the shorter term fluctuations, but you can see that this has been in a very narrow range recently. And since about February this year, there's been a fair bit of indecision. You can see how the dollar at times has peaked and then pulled back as investment flows went against it. You can see a bit of a dip there in April and then a return as US markets rallied back. So it is a good sentiment indicator for investment in the US in particular. It's one I look out for, but the keys for mine on this chart are those levels around 140 So if the US dollar were to fall below 140 yen, for mine, that would be a sign that US markets are in corrective mode, US share markets. But while it continues above that level, and if it heads higher, it would be a sign of increasing confidence and potentially a sign that the upward trend in US shares was continuing. So that's another reason why I watch dollar yen. And here's the euro versus US dollar. Now, remember, this is the euro in US dollars. So when this chart is falling, the US dollar is getting stronger. And it's one of the reasons why I turn to this. It does suggest, when we compare it to the dollar yen chart we were just looking at, that the strength that we're seeing in US markets is coming from European investors. You can see here that continued pressure on euro-US dollar indicates ongoing buying of US dollars and selling of euros. And that does suggest that European investors are swinging back towards the US, having sold off hard, as you can see earlier in the year. And so that at the moment, I believe, is what's buoying US markets. If we started to see euro-US dollar drifting higher again and dollar yen drifting lower, that might be another sign. So two currencies I'm watching very closely to see how they pan out and to monitor international investment flows, particularly into US markets, because there's no doubt that US markets are leading the globe at the moment. Before we go to the questions and comments, and by the way, thank you very much for sending those through. You can continue to send your comments and queries and questions through in the chat box you can see next to this window. But before we go to those, I'd just like to touch on some key stocks and the way they performed through the earnings season. And as you can see, I've got 6 Australian stocks on this screen. Now, the whole point that I'd like to make here is that even more so than usual, the reporting season just passed had an enormous impact on individual stocks. And not only did it impact them on the day that they released their results, those impacts have continued to have an effect on the share price in the following days and in some cases weeks. And that's what this chart is about. If you look at the top 3 there, we've got Pilbara Minerals, Iluka and Boss Energy. Now, all of these reported strongly, and you can see the blips in their share price where they supported. But look after they've moved up strongly, and you can see they've continued in that direction. In other words, those strong reports they've delivered appear to have led to a re-rating of the stocks and ongoing buying, ongoing support for their share prices. And that's in a very strict contrast to the experience in stocks like James Hardie, Domino's Pizza and Boss Energy, who have reported less well than was forecast and been punished for it. And the push that we're seeing in stocks where they have reported poorly has been concerning. Some are stabilising. Domino's stabilising more than the other two. James Hardie looking like it's going through a very significant re-rating that is ongoing. Its share price down 50% or so after, first of all, disappointing shareholders by making a takeover bid without seeking their permission, relisting in the US without seeking shareholder permission, and then delivering a very poor quarter. The pressure on its share price does appear to be ongoing. So the important takeaway here, in my view, is that individual stocks are responding very distinctly to the reports they're putting out, and those effects are not just on the day effects, but seem to be ongoing. So if you see a stock you like that's reported well, you might well, on the basis of these sorts of performance, start to wonder if it's going to continue to outperform, and it may well do. It was a very similar situation with US stocks. Now, I've stripped out some of the best and worst just to illustrate the point, but you can see here with AMD, Oracle, and a number of others that the Arista, the gains are very significant around those reports, and they've continued on with an upward trend, whereas those who disappointed, like Accenture, Fortinet, and Lululemon, all came under very significant share price pressure, which once again appears to be ongoing. So one, it illustrates something we've talked about before here, that earnings revision is one of the surest predictors of share price movement. If analysts and investors are revising earnings upwards for a share, it's more likely that share price will be rising. If they're downgrading their expectations for earnings, it's more likely that share price will be under pressure. And that's one of the best indicators we have in the market of where share prices are heading. And so earnings reports are even more important than usual. On the Moomoo platform and in the app, you can use our AI-enabled summaries of earnings to get an instant grip on earnings reports as they are released. Those AI summaries are generated almost simultaneously, and so you can be amongst the first to understand the implications of an earnings report if you use the Moomoo AI-enabled earnings report. But you can see how important that is. And it's likely, given the dominance of individual investors now in markets, that those individual stock performances will also continue to be very important and a big part of the trading and investing landscape. So thank you for your attention to these. Please feel free to agree, disagree. There's plenty of room in markets for honest disagreement. After all, we're talking about the future and none of us can be certain about that. Please feel free also to put your queries and comments and questions into the chat windows there, and we'll see how many we can get to in the rest of today's session. Are we in a bull run? If so, how much further is there to go? Well, I don't think there's any doubt we're in a bull run, and that's the point I was trying to make about the momentum in share markets. And while I only illustrated that with the S&P, with the NASDAQ 100, whichever market you go to, it's very likely you'll see or be able to draw a very similar uptrend line, and particularly in markets like Australia, where we are at or very near the all-time highs, those uptrends are clearly in place. So it's not hard to identify the uptrend. When the uptrend is breaking will be very, very important information, but whether that's tomorrow or next month or next year is a decision for every investor and trader. Which US sectors will grow the most, and will a rate cut affect that? Well, first of all, which US sectors will grow the most depends what we mean by grow. Do we mean earnings growing? Do we mean share prices growing? Because at the moment, valuation is such an issue that it's all about momentum. So I would suggest those that have shown the best momentum are likely to continue to show that, and that dynamic will come to an end during a big change in market conditions. And what that change in market conditions will be, I don't know. So in the meantime, where you've seen momentum, likely to see momentum. Be aware that change could come very rapidly when it does come. And if that's the case, all bets are off and we have to reset and rethink strategy for any new market conditions that might emerge. A rate cut, yes, will affect which sectors perform. There's no two ways about it. Certain sectors are much more sensitive to lower or higher interest rates. And so that will change things. But a lot of it will have to do with why interest rates are moving. And if, for example, interest rates are moving because unemployment is blown out to 6% in the US and growth has dropped close to zero, then the sectors that will perform will not be as obvious, and there might be a significant adjustment and correction in the market before any benefit is delivered to market performance by lower interest rates. So one to watch out for. How will the weakening US dollar and coming interest rate cuts affect US stocks performance in the near future? Well, once again, I'm not sure it's a given that we have interest rates. I know that that is market consensus, and that's certainly what market pricing is reflecting. I am a bit wary of that assumption, and it is an assumption. And I think one of the things that the Fed has been signalling and others around the globe have been signalling is a shift in their thinking, and that their quick responses to weakening conditions during emergency times might have misled some into thinking they'll pull the trigger just as fast in less concerning times. And I suspect they won't, and that we might not see those rate cuts. Now, the impact of that is likely to be a slow burn because we've seen before last year, for example, when the Fed was holding off or the RBA held off, market expectations of rate cuts didn't disappear. They just kept getting moved forward. And so we could see a similar situation where those expectations keep rolling forward, but the rate cuts are never delivered. In that scenario, we have a fairly steady state, and markets are likely, in my view, to continue on their way. Do you think there is still room for the Magnificent Seven stocks in the future, since almost all are at high valuations now? Well, yeah, I mean, I think you're touching on exactly the dynamic that we're concerned about in markets at the moment, that playoff or the trade-off between very clear upward momentum and stretched valuations. Now, very famously, one of the groundbreaking economists of the first half of the 20th century, J.M. Keynes, said that markets can remain irrational longer than you or I can remain solvent. And he was making a very strong point. And he was speaking from experience. J.M. Keynes is one of my favourite economists, and that's not a phrase I issue very often, but he's one of my favourite economists because he tried to use his economic theories to trade the markets. And if you've studied economics, and particularly classical economics, you would probably understand that he went bankrupt twice. So I like Keynes because he tried to put his theories into practice. In other words, he honed his knowledge and his expectations against the market. Unfortunately, it was found wanting, but that didn't stop the world adopting many of the ideas that he pioneered. Nonetheless, markets can remain irrational longer than you or I can remain solvent. In other words, even when we're saying this is crazy, the market can keep going in the same direction. And even when it's very hard for us to fathom what's going on in markets, the market is always right. And that's a discipline traders and investors must respect. The market is always right. And if you ever find yourself saying the market is wrong, my suggestion is it's time to cut that position. So I do think there is room for the Magnificent Seven to continue. The momentum's been there. The NVIDIA result just unveiled was absolutely stonking. 75% growth in 1 year in terms of revenue. It's incredible, the growth that they're delivering. And under that scenario, I can justify positive momentum. At some stage, these valuations will come into play. But as I say, whether that's tomorrow, next week or next year, very few of us, well, none of us know with certainty. So what signals should investors watch for to distinguish between a healthy rally and signs of an impending correction? Well, I'd suggest that those things can exist at the same time, and it's what I've been touching on. I'm looking to those other important indicator markets to give me clues as to when the bull run might be over, because I do think now we're very much in sentiment territory. The markets are running on momentum. They're running on an expectation that this bull run will continue. And it will continue while those expectations remain. So it's about anticipating or understanding when the market is changing its thinking. And as I said, I'll be looking at the Dow Jones chart as initial indicator, the NASDAQ 100 chart, the 10-year bond chart in the US, and the dollar charts, dollar yen and euro US dollar, to give me clues as to when sentiment around those US markets, and by implication the global share markets, is changing. So the price action is the answer. That's the signals we should be looking for. Real evidence, changes in price action that tell us that the market thinking is changing. Is Bitcoin still a strong asset to invest in? Well, I would dispute the premise of that question. It's never been a strong asset to invest in. It is not an investment proposition. Bitcoin is a speculative proposition. And the proposition is one of two things. One, that it will become a global currency, or two, that it will become a recognised store of wealth, or it has already become a recognised store of wealth. So we know, for example, processing costs in Bitcoin mean that it cannot ever be a global currency. It could not replace the US dollar. It would take more electricity than the world currently produces just to produce the daily transactions. So it can't be a global currency, but it could be a store of wealth into the future. And once again, this depends very much on market sentiment. While people believe Bitcoin is a store of wealth, it will remain a store of wealth. The difficulty with digital currencies is that perception could shift at any time. So once again, for me, it's about the price action. I want to understand what the crowd is thinking, and understanding what the crowd is thinking and staying attuned to that might be the best way to understand where Bitcoin might be heading. So not a strong asset, speculative asset. Doesn't mean it can't go higher. It certainly could, but it might also go to zero. And it's something that everybody who gets involved in crypto should understand. Risk and reward, once again, closely related. Those high returns we've seen in crypto markets bring with them potentially very high risks, something to keep in mind. I'm not saying don't play there, but just everybody should be aware of those risks if they're going to get involved in cryptos or remain involved in cryptos. Are we witnessing the rise of the Hong Kong market? Well, I'd certainly argue we are, particularly as we pointed out a number of times over the course of this year, those valuations. Now, the Hong Kong market has already played catch-up as measured by the Hang Seng Index, and there are good reasons for that. I touched on the Alibaba situation earlier this week and the strength it displayed as it bounced back. There are a number of other top quality global companies listed on the Hong Kong exchange. And with the Chinese authorities sorting out their property concerns to some extent, the outlook remains positive and the valuation looks attractive relative to the rest of the globe. So, yes, I certainly see the potential for a rise in the Hong Kong market. How that will play out? Well, there's a lot of uncertainty globally and locally, and so we can't. I'm not making a call for the years ahead, but there are certainly arguments that the Hong Kong market could continue to outperform as it has done already. How should investors balance pursuing gains with managing risk in this elevated market? Well, that is a very interesting question. And the answer to that will depend on you, your goals, your time frame, and your risk appetite. Now, some people will write it out. They've got a long-term plan. They're prepared for the fact that share markets pull back regularly, and they're prepared because of a longer time frame to ride out those pullbacks. For others, it's a matter of going to cash and trying to safeguard their investments, protect some of their capital in case of a pullback, which they'll be ready to deploy into the market if that pullback comes. For others, it might be using instruments that benefit when the markets fall, and whether that's a short ETF or whether that's a put option is a matter for each investor to decide. And of course, it's important to understand these instruments if you're going to use them. The Moomoo Learn area has a lot of information, but there's plenty of information available elsewhere, of course. But if you're going to use any more sophisticated instruments, it's very important that you take the time and effort to understand the risks involved. But that's certainly something we're seeing, that people are using their own methodology. The other tool, of course, the one that's available to all investors, is diversification. And I think one of the reasons we're seeing such good support for gold at the moment is, and for property trusts as well, is that people want to stay sort of with the share market. They don't want the trouble of moving around or making a large purchase of a physical asset. But by moving into real estate investment trusts or into gold stocks, they are diversifying across the asset classes into property and gold while still keeping their funds in the share market. So I think that support we're seeing is also another risk-based response, that some people are responding to the elevated risks that we're perceiving in the market at the moment by diversifying across asset classes. So the response, as I say, depends on you as an individual and your circumstances, but we're certainly seeing responses that indicate that people are using different ways to deal with potential risks. What economic indicators should investors monitor closely in coming months? Well, no doubt in my mind that that's inflation and unemployment. The other one I'd be looking at is GDP growth. And by the way, we do have a GDP read here in Australia tomorrow. So growth will be important to central bank decisions as well. But jobs and inflation, they're the key criteria for central bank action. And for that reason, and given the market thinking and dependence on the idea that central banks will cut rates, I'd say they're the two most important economic indicators. And of course, at the micro level, it's about earnings reports for individual companies. How might global geopolitical developments impact market performance in the near term? Well, that's a very interesting one, because we have some very concerning developments in the world at the moment. And whether it's Russia, Ukraine, the Gaza, Middle East, or the various conflicts across North Africa and Central Africa, there is potential in a lot of hotspots around the globe for things to get out of hand. And yet the markets have been largely immune to that. And even when the Ukraine war brought disruption to energy markets, although there was a huge reaction in energy markets, share markets seemed able to shrug it off. So at the moment, I would suggest the markets are largely immune. Now, if we start to talk about potential trade conflicts between the world's major economies, i.e. the US, China and Europe, we better include India in that basket now. The reality is that will very likely have an impact on investor thinking, but without the involvement of those major economies, it does appear that markets are quite comfortable with lower level conflicts between less powerful economies. A little surprising to me, but that seems to be the reality at the moment. And as I say, the market is always right. I'm aware we're a little over time. I do apologise for that. I understand if some of you need to go. I'm happy to keep talking as we haven't got to as many questions I would have liked to. So please feel free to leave us here if you so wish, but I will continue to deal with questions for a little while longer at least. What are your views on the bond market? Will bond ETFs fall when the US Federal Reserve cuts rate in September? Once again, I don't think it's a given that rates will be cut in September, despite the fact the market does. Now, I admit I'm out of line with market thinking here, but if rates are cut, generally speaking, we do see a rally in bond markets, and that should mean that ETFs rally. Now, that's what should happen. But one of the interesting aspects of markets at the moment is a lot of what we expect is already priced into the market. We're getting a lot of surprising impacts because people are moving ahead of events to position themselves, which means when the events occur just as they expected, there's nobody else to move the market in that direction. So I'm a little wary about some of the thinking expressed here. They may well be right, and we could well get a cut, and conventional wisdom will play out, bonds will rally, and ETFs will rise. I'm not assured of that. And once again, it depends on the circumstances. If, for example, there was a perception that the Fed gave in to political pressure to cut rates, the market reaction, the bond market reaction might be very, very different to if the perception was that the Fed was merely supporting the economy. So this is a very open question. Any idea that the Fed's independence has been compromised could see a rout in US bond markets. Let's be very clear. If the Fed is no longer in control of its book, then the potential reaction in markets could be very severe. So I would be very careful about that. And it's one of the reasons why the bond market and the 10-year bond is on my watch list, because if there's something going wrong in the bond market, it's going to spread, and we should all be aware of that. So I think, in a convention, if there's no disruption to markets, then yes, I agree, a cut in interest rates should see bond ETFs rise. However, I do point out that there are very significant risks to that scenario at the moment. Best Australian sectors until year's end? Well, I'm going to combine when is the best time to buy. Well, yeah, that's a great question. Best Australian sectors until year's end. One of the things we have highlighted earlier in the year, and we are seeing continue to play out, is good support for mining stocks generally. There's a very constrained outlook for commodity prices, and as we saw in the overnight action, when we see a bounce, last night we saw iron ore, silver, platinum and palladium all moving up strongly higher, and oil prices up. And that takes the market by surprise. Markets are expecting a constrained economic environment overall and not much support for industrial commodities. And that hasn't proved to be the case. And if that is still true over the rest of this year, then it's likely the resource stocks will continue to outperform the rest of the Australian. And I don't think this is not a time to outsmart ourselves. I think the major plays, the major global plays in the key commodities, and each investor will have to decide what those commodities are for themselves. If you think it's iron ore, it might be Fortescue. More global play might be BHP or Rio, and more diversified metals play might be South 32. But whichever you favour, the potential for surprising commodity prices and therefore commodity producing stocks is, I believe, still real, and that potential could see that sector outperform, as I believe oil and gas stocks could outperform over the year as reality bites the political energy equation. If the tech bubble bursts, will there be a long-term correction? Well, absolutely. If the tech bubble bursts, there goes half the market in the US. And remembering that only, I think it's 10 stocks have contributed almost 50% of the gains in the S&P 500 over the last 2 years. We have a very narrowly led market. It's in tech, and if that bursts, then yes, we are very likely to see a significant correction in markets in the US and globally. What's your biggest fear? Well, it's got nothing to do with markets. Well, we see a black swan event. Well, by their nature, black swan events are unpredictable. And that's the thing about it. What really moves markets is surprises, something that the market wasn't expecting. And by definition, surprises are unpredictable. And the way professional investors deal with this is to be ready at any time for a surprise, to prepare an investment strategy that recognises that market corrections, pullbacks, and even crashes can happen at any time, and that where our investment strategy should incorporate that information, that we should either be ready to pivot or be prepared ahead of time for the fact that markets do regularly pull back. So black swan events, like the one thing we can say is that they rarely come from where they came from last time. So it's not likely to be a global pandemic nor a debt market crisis. I did see a very interesting article this week suggesting that Europe might be the source of any global contagion the next time around, as its economy moves backward, and particularly its energy dependency makes it vulnerable to an economic pullback or even a crash. So interesting piece. As I say, the black swans tend to come from where they have not come from recently. So the other potential, of course, is a significant global conflict, which I'm reluctant to mention because none of us wants to see a significant global conflict. But if that were to arise, and it does appear that global tension is higher than normal, if that would arise, that of course would be a terrible black swan event for markets. Young investors' time horizons are long. Should they chase stocks and higher risk buys or stay conservative and diversify? Well, that question depends very much on the individual young person, because it's not just time horizons that drive investment decisions. And one of the factors that should or be incorporated, I believe, into investment decisions is risk appetite, the sleep at night factor. If you were to put all of your portfolio into, say, cryptocurrencies, and those cryptocurrencies might have terrific potential, and if you're a believer in the outlook for cryptocurrencies, you might have a view that in 30 years' time that'll have made your fortune, and you're prepared, if you're wrong, to start again, and you can sleep at night knowing those things, then that might be the right play for you. If you want to utilise the power of time, and we know that compounding interest is one of the most powerful paths to wealth, then starting early and being conservative can also pay off very well. Protecting your capital at all times, making sure you're making gains each year, and that you get gains based on those gains is another way to wealth. So the answer to whether or not you should take a conservative outlook early in your investing career or an aggressive high risk outlook depends on you as much as it does on the markets. I think that's a good note for us to end on, folks. Thank you for joining this Moomoo live presentation. The recording will be available if you'd like to share it with your friends. I apologise if I didn't get to your comment, query or question in this presentation. I will try and get to as many as I can in the live post you'll see up go after the event. And please keep an eye on the app and our website for our next live event.